Hi, my name is Possible from Quelly Finance. In this video, we are going to look at a scenario where someone is looking to buy a property and what sort of a calculation or assessment we do and the lenders also do to be able to determine if you can purchase that property and you'll be able to afford the property based on your circumstances, based on your household income, based on your expenses, and based on the dependent that you have, and will also determine if you can buy a property or you'll be able to afford to repay. And in this example, I'm going to use a couple with two kids, and it is a family of 4 people, and the husband is receiving $71,000 a year, and the wife is on $89,000 a year, and the total income for the whole household before tax is $160,000 a year. And then let us assume the living expenses for this family is $5,456. The total household expenses for 4 people, and then their net monthly income, that is after tax, let's assume is $10,000 a month. For this family, let us assume they have no liability. That means they have no debt. And then when applying for the loan, the lenders usually make sure that there is at least around 3% buffer. So that means if you apply for a loan which has the interest of 5.8, so the lender has to add an extra 3% to that. And this 3% will give you 8.8%. That means if you apply for that loan, you will not be paying the 8.8%. You actually be paying the actual rate, which is 5.8%. So the bank has to include that 3% to check that you can actually afford the loan once the interest rate reached 8.8. But that doesn't mean that's what is going to be your repayment or your interest rate, but you'll be paying your interest rate at the actual rate. Put all this together based on the scenario that we had and the couple that are buying the property. So let's assume the couple are looking for a house which is at a price of $650,000, and they only have $50,000 deposit in their bank account for savings that they want to use toward the house. Now we have to calculate what is the lender's loan to value ratio for this particular property. So how do we calculate the loan to value ratio? So we'll say the loan amount we're going to be divided by the property value. So in this case, which is 600,000 divided by 650,000, which gives us to 92.3% loan to value ratio. So this means the couple can only borrow up to 92% of the property value. So in this regard, or in this case, the lender's mortgage insurance will apply, and that's unless they are applying for the 5% scheme guarantee, which is from the federal government. And in this case, there is a stamp duty in South Australia who has to apply. We have to put on top of that, which is around 29,580 of stamp duty we have to consider. And then there's other costs as well associated to buying that property. We're looking at conveyancing fee, which is around 1,500 to 2,500, and then there's a transfer fee of 1,700, and the registration fee and building and inspection fee as well. So we are estimating around 4,000 to 5,000 of extra costs that will be added on top of that, and this is on top of the 29,580. And then if we put everything together for how much cash, how much money does the couple need to actually get that house. So if we put they have a deposit of $50,000, and then we put stamp duty there and other associated costs, then we have to make the couple need at least $84,000 to be able to afford that. So I'm going to make a calculation to see if the couple can actually afford this loan, and also to see how much money they will have left after all the expenses. So let's assume they have $10,000 as their monthly income, as I said before, and their living expenses, which include the clothing, the grocery, the electricity, gas, and everything, school fees, and the whole monthly expense is $5,456. And then if we do that $10,000 a month minus this expense, which give us the surplus, which is the money remaining, that they can use this money for servicing the loan. And then let's assume, because they're getting a $600,000 loan and their monthly repayment is around $3,500, that means they will still have some money left. That means they can actually afford this loan, and the lender can actually go forward and give them this loan because they will be able to afford the loan. Thank you very much for listening. A few things, a summary that has been said, and things to put into consideration when you want to start looking for a new house. Make sure you also have done your own budgeting. You make sure that you check how much money you spend on food, groceries, entertainment, on electricity. You pull all that together, and now you check how much do you actually get. Do you have any surplus or any extra money that is remaining that you'll be able to use to service the loan that you want to get? That's very important. You check all that before you can contact us. Make sure you have checked all that, and then we'll be able to go through with you. And also the lender also goes through the same to make sure that you'll be able to afford the property that you're looking for.